Welcome along to the next in this video mini-series, Finance Innovation Insights, powered by Brightstar Financial. And joining me now, we're going to talk about tax. And I'm with Alex Bari, who is Property Tax Specialist at Barnes Rolfe LLP. And Alex, thanks for joining me. And in this day and age, we just can't have a conversation about finance without also including the landlord's tax position, because so much has changed, hasn't it?
Yes, you're right. The two are now inextricably linked, whereas previously finance was something you needed to be aware of. The tax implications of it were quite straightforward. You would get a deduction for it, and if you made a profit post that deduction, you would pay tax on it, and if you didn't, you wouldn't. However, as you say, the landscape's changed so much because of the new rules that have come into force that it doesn't necessarily follow that you will get the tax deduction you think. In fact, it's starting to be restricted to the basic rate of tax. So it has a huge implication, especially for higher and additional rate taxpayers.
Indeed, and we're talking about Section 24, which was introduced by George Osborne and is now coming into play. You know, that big question that all landlords need to ask themselves is, should I incorporate, should I buy through a limited company?
And the answer is different for everyone.
Indeed.
I mean, there is no one straightforward answer. So you're right. The implications of the changes are going to, for many people, going to come to realisation now. The tax returns for 17-18 need to be filed by the end of the month. So for many people, it will be the first time they really see what effect it has on them, and there will be some unpleasant surprises out there for many people. The question as to whether should I incorporate, should I buy through a limited company, again, it depends on the individual. For lower rate taxpayers, this may not have an impact at all. It depends what their income tax position is, what their other income is. For additional and higher rate taxpayers, again, it will have an impact, but the question then becomes, have they got a property portfolio already and they need to incorporate it, or are they just setting it out, and what they hope to achieve in the long run from that? Do they want to become, property investors and build up a portfolio and recycle all the profits they make from that property portfolio back into buying more properties? Then the answer is almost certainly you should buy in a limited company. Whereas if they want to take all the money out and spend, generate a revenue source that they can spend as they want, not for the purposes of expanding the business, then the answer isn't quite as straightforward. But it may well be that it's still worth buying in a company. As to whether you should incorporate a property portfolio, again, an analysis needs to be carried out to see whether that's the right thing to do for each person. Now, there are ways of incorporating that are tax neutral, but again, it depends on the individual circumstance. And if you don't fit one of those particular circumstances, you can be hit with a huge capital gains tax bill, or even worse, a huge stamp duty, land tax. So whereas the interest restriction rules do apply to individuals, they don't apply to companies. So a company will still benefit from 100% deduction for their interest costs. And if you add to that the corporation tax rate is 19%, falling towards 17%, and you compare that against personal tax rates of 40%, 45%. If you have your personal allowance tapered away, it can get up to 60% marginal rate. Then there are definite benefits to holding property in limited companies.
So when a client comes to see you with this question in mind, what sort of things do you look at in order to make your recommendations to them?
Ultimately, it is a question of how much of a tax saving can be generated by holding in a limited company, if indeed any can be at all. Against that, you need to weigh up the additional compliance costs of having a limited company, and you need to understand what their goals are, because again, when a limited company makes a profit, although it's taxed at low rates, and although you get the benefit of the full interest relief interest deduction, if you want to get your hands on that money, there's another layer of tax that you are going to trigger. So you can take it out. The most common form is dividends, but
Yep.
you know there's other methods you can use to take the money out. And as a shareholder, you will then pay income tax on that dividend. So again, it comes down to, I suppose, a mathematical problem that you need to solve, and based on that, you get an answer. But there isn't a right or wrong answer, and it does need to be sort of tailored to the individual.
And I think this leads me to say that now more than ever, landlords do need to seek tax advice from a specialist such as yourself, because as you've very eloquently said, you need to do a before and after scenario. Numbers never lie, they tell the truth, and that will determine the best way forward for each individual. And you know, landlords typically balk at putting their hand in their pocket and paying for professional services. But the message that I particularly want to get across in these kind of interviews is that actually in the long run it saves you money, it makes you more tax efficient, and all of that is what smarter landlords should be doing in this day and age.
Absolutely, they need, especially landlords that are looking to expand property portfolios and maybe do it more, let's say professionally. They need the right structure to do it in, and it isn't, you know, that there's other benefits to holding property in limited companies, to having a corporate structure aside from just the tax, but it all needs to be looked at and taken into account, and the professional fees, as you quite rightly say, some people balk at them. That's all part of the decision process. So you need to consider those when you weigh up the pros and cons of say incorporating or structuring your affairs slightly different.
So the bottom line is, it's not a case of one size fits all, and that all landlords should really be seeking professional advice. It is a complex area of taxation, isn't it? And indeed, to go to somebody that specialises in this, maybe not just your local high street accountant.
No, absolutely. There are, I mean, it is highly complicated advice, and there's numerous pitfalls that you can fall in. I think people talk about property incorporation. It's quite widely known. We're not breaking new ground here. Most people are aware of it, but there are numerous pitfalls you can fall into when you're incorporating, and some people will attempt to put square pegs into round holes, and they might market that as a possible solution. You need to be incredibly careful, because incorporating and not doing it properly will trigger capital gains tax charge if you don't meet the requirements to qualify for Section 162 relief, which is incorporation relief. And almost more dangerous is the stamp duty land tax implications of incorporating. And if you are not in the right, if you don't have the right structure to incorporate, you could trigger huge tax costs, and they will be retrospective. If HMRC were to later challenge it, there is no winding back the clock pretending it didn't happen. These taxes would be triggered and payable.
Well, that's absolutely brilliant advice, Alex. Thank you very much for joining me here on our Finance Innovation Insights powered by Brightstar Financial. Hope you've enjoyed this video, and more to come.